Good morning, everybody, and welcome to everybody who's tuning in on the live stream this morning. Well, here we are again with the second budget from Rachel from Accounts. Probably should point out that other names are also available. The speculation around this budget has been equally as intense as the first, even, as much as the Office for Public Relations basically decided that they wanted to put all the details out early for as well. They got so excited, which I'm sure the meeting yesterday with whoever actually, pressed send was quite amusing, I think, at that point. But to run through this morning's agenda, Richard is going to start with the main points from Wednesday's budget, and then I'm really happy to be inviting along Corinne Lloyd, who is an investment consultant for St James's Place. Corinne is going to go through basically the markets this year so far and where SJP's take is on where they might be going into next year, basically. Richard will then follow on with some general updates, and then there'll be a questions and answer session. So if anybody's got any questions for either of the sessions, if you can leave it to that point. The feedback sheets just before we start, if you can fill those in and hand those in on the way out before you leave. I hope everybody finds it really useful this morning, and I'll hand over to Richard and we'll get started anyway. Thank you.
Morning, everyone. Lovely to see you all, and overriding sense of relief, I think, around the country that the budget is over, isn't it? I think whatever anyone thinks, whatever political persuasion you are, the length of time it's taken, the press speculation hasn't been good for virtually everyone. But we're finished and we're through it. And I think very quickly, the city market was up at the end of Wednesday. Bond yields had fallen slightly, so the city actually was calm, certainly. Would you say positive, calm to positive? I think the big takeaway the city took was that the headroom that was very small from the last budget is up to 22 billion. And why the city likes that is it means that we won't have the OBR going backwards and forwards with the Treasury and causing sort of panics. And the OBR is only going to do an annual assessment rather than 6 monthly. And so there's a general feeling that the heavy lifting of significant changes and speculation will go. Hopefully the government and the Treasury and number 11 will learn how to better handle a budget and speculation going forward, and everyone can just be calm. You can still be angry, but you can be calm. And it is over and done. I'm not putting any notes. There's a lot of information on our website at Eaden Wealth Management. A lot of you get the emails. If you don't get the emails, when we have a news bulletin, of which we've done 3 in the last couple of days, just put that on your feedback sheet, tick some boxes in the feedback sheet, and we'll get back to you. And so I'm going to use the words from the budget in my headlines. Firstly, asking everyone to contribute was not mine, but Rachel Reeves and the Treasury's words. And obviously, we all are aware that this budget has raised another 26 billion over the period of time up to 29-30. So it is raising further taxes. And the big heavy lifting is the extension, which everyone now knows about, the personal allowances, which, again, were frozen under the previous government from April 21. But the extension of that freezing will go right through to 2031. And that alone of the 26 billion that's going to be raised in extra tax is 8 billion. So you can see it's very, very significant. And I think the number of people paying tax that aren't will go something up to 5 million, and the number of people going into higher rate tax by the time we get to 2031 will be an extra 5 million. So this will be very significant. And again, don't forget, it's more tax, but it's based on people earning more. Pensions going up by more, but the tax take clearly going up. Inheritance tax I will come back to. Not even really mentioned. In fact, one rather positive aspect, which we'll come to for farmers and business businesses, but the bottom line is that the take on inheritance tax is going up by 74% estimated between last year and 29-30. So the government's own figures and their own estimates in how they get to everything is that there's going to be a huge increase in the levels of tax to come down the road. So everyone is contributing there, but then the words again from the Treasury, raising revenue from the sources of wealth. And that's in the Red Book. It's repeated about 20 times. And what I'm doing here is firstly showing you how they're doing that from last year. So they raised the CGT rates last year, nothing touched with capital gains tax this year whatsoever. They put VAT on school fees, as we know, and just looking around Yorkshire, we've seen Queen Margaret's closed already at Escrick. I think there were issues before. Just here in Harrogate, the famous Harrogate Ladies College, going co-ed right through to 18 and being renamed. So it's having a very significant impact on that area of the market. Again, last year, the level of business owner relief on sale of business was increased. And we had, as you will all know, sitting here in the Yorkshire Showground, farmers and business owners getting irate about the cap on the relief against inheritance tax being £1 million per person. And tractors were outside Westminster continuing that fight. And very briefly, as I've put here, this is not from last year, but on that little note, what has happened, which is positive, it's a step in the right direction, was if you're a farmer or business owner, to use your relief up to £1 million, you had on your death, if you were a husband and wife, to give it away, to pass it to the next generation, which in many cases was completely inappropriate. I've got a number of farmers that haven't got capacity, so they couldn't change their wills, so they were stuck. And what they've done in the budget is they've done what they do with your normal inheritance tax nil rate bans. If you don't use it, that farmer, that business owner, can transfer it to the spouse, so the spouse can use it. So you've, in some publications, which are more left of centre, shall I say, they're talking about a 3 million exemption for IHT. Well, that's if you own a business or a farm valued up to 2 million and your normal £1 million IHT allowance. So that's a relatively minor point, but a positive one. And then affecting quite a lot of people in this room, the change to legislation with regard to pensions at the point of death. There's some subtext come out, which is slightly better, but it's going to be a bit of a nightmare when we get that introduced in April 27, so not even next year, but April 27. And then, again, we've had the whole fiasco of the winter fuel payment, and I will just talk on that. So they were already in there. And then what we have, again, raising revenue from sources of wealth. Well, if you've got some shares, and those shares give you dividends of in excess of £500 per year, then the level of tax that you pay will go up by 2%. And a real quirk here, it goes up for basic rate, it goes up for higher rate, but it doesn't go up for additional rate, which is where you're paying, your overall income's above 125,000. So they're taxing dividends a little bit more than they were before. That comes in April 26, and you'll see a lot of the measures that I'm going to talk about announced on Wednesday are staged over a number of years, and we'll come back to the significance of that later. If you're into VCTs, from again April 26, the relief you get is down to 20%. And there's quite a bit of detail. There's some things we don't quite know about how these things are going to work. One comment I found interesting in the release, at the bottom of the release on savings on taxes and pensions, property and savings was, and I'll quote, "The majority of pensioners have no taxable property, i.e. second property, savings, dividend income, and will pay no more tax as a result of these changes." I'm not quite sure, they didn't qualify how they got to that figure, but I suspect certainly in this room that's not the case. So continuing the theme, but moving a year on to April 27, at that stage, if you are a second property owner or a multiple property owner that gets rental income, and if you have savings, which I'll define, then again the level of tax you pay on those is going up by 2%. Or by 2p. So straight across the board, 20 to 22, 40 to 42, and 45 to 47. But again, and I'll talk about this, for savings, you've got the personal interest allowance, which I'll come back to. Property, that's what you're doing. So straight away, there's extra tax. And immediately you're beginning to think, well, how's this going to work? And I'll come to that. Other changes, again, minor thing, but if you sell your business to an employee ownership trust, which has become increasingly popular, that's immediately changed with reduced levels of CGT incentives. From April 28, we've got they have to have flashy things, don't they? High value council tax surcharge. Effectively, if you're lucky enough to own a property of 2 million, you're going to pay 2,500. It goes up to between 2.5 and 3.5 million, 3,500, 3.5 million to 5 million, 5,000, and 5 million plus 7,500. And that was widely flagged. They call it, I guess, the mansion tax. There's going to be a lot of work put in to get that going. It's going to raise 400 million, which in the big context is very little. Just for freezing of rates is 8 billion. The mansion tax is 400 million. What's that all about? It's clearly appeasing the left of the Labour Party. And this is quite a political budget. And what's important for someone like me is to read The Guardian and the wider publications. No, that's a serious comment, ladies and gentlemen. To hear the scope. And a lot of the response on the left was very high levels of disappointment. That mansion tax was going to be set at a much lower level, as was leaked, and just before, I think the cynics were saying Starmer and Reeves's houses in London are around 1.5 million. I'm sure it was nothing to do with that, and so we ended up with £2 million. Salary sacrifice, that's going to cost business. So in April 29, at the moment, if you get a bonus and sacrifice it, not only do you save as an employee quite a bit of income tax and NI, you save your employer quite a bit of NI. I'm surprised that we've not seen the people in the British industry, the directors saying something about this. I guess it's not coming into April 29, but that is going to hurt business, and obviously it's going to see people put less in. And then we've got the consultation, well, the asking electric owners to contribute. I've tried to put the government slant on this, in that if you drive petrol and diesel, as I have to confess I still do, I pay my fuel duty to make sure the potholes are mended. I think that's what Rachel said. Drivers of electric cars don't make that contribution, but they're going to. And as she was questioned, I recorded Martin Lewis, watched it quite late last night. How on earth are you going to work that one out? And there is some semblance of comment here. It again doesn't come in for a couple of years till April 28. And it sounds like, obviously, if you've got a new car, you don't, MOTs will be the way that they do it. But if you've got a new electric car, no one does it. Her answering seemed as though she hadn't thought about that. But it would appear from further feedback that you're going to have to report your brand new electric car to an MOT person who will literally read it, and then it'll cost an absolute fortune, but then the revenue will be raised one way or another. But obviously we got till April 28. And then other aspects which again were clearly aimed at the left of the Labour Party, the two-cap benefit with two-cap child benefit on universal credit being removed, the living wage, effective a minimum wage, up by 4.1 for 18 to 20-year-olds, a significant rise in their minimum wage. You could argue overdue. A state pension, a triple lock, which people seem to be very much avoiding, whatever party, up at 4.8%. The one fact is both public sector pensions and the state pension are unfunded. They're not in the book, and they cost this country a fortune. So who knows who will ever be brave enough to address those issues. And then a very small thing, positive, that there will be a stamp duty holiday on purchasing shares in new companies floating on the stock market for a 3-year period. So just to click through the state pensions, these are the different rates starting. The significant point is, look where the new state pension, which is the one if you retired after April 2026, 12,547, the threshold to pay tax, £12,570, £23 away. They have put, to be fair, even though I don't think Rachel Reeves knew, because her answer again on Martin Lewis was a bit vague, in the Red Book that they're going to consult on what happens when that state pension goes through the threshold, which it will do next year. Unless the triple lock unlocks, it's going to go through that. And what Rachel Reeves said live on Martin Lewis was, if someone's pension is only from the state pension with no other pensions, they won't go for you, and it would cost more than the tax, I guess, raised. But what she did say is, if you have other pensions, then clearly if your state pension, as an example, I'm making it up, is £1,000 more than the allowance, you owe £200. The state pension, as you all know, is paid gross, and that £200 will be reclaimed for your coding notice on your other pensions. And I'll come to that, because this is becoming a bigger and bigger point for pay-as-you-earn code pensioners. So we need to watch that. ISA reforms, widely flagged, irrelevant for anyone here. A few of you may be over 65, but so it's irrelevant. No change at all. The 20,000 sticks, but for your children, or if you're under under 65, the cash limit on cash ISAs will be 12,000. And again, that's no effect on anything you've done whatsoever. It's clearly trying to say to any young person that's got a reasonable amount they can save, firstly, you can still do your cash ISA if you wish to, but they're trying to get people to actually take a little bit more risk. Be aware that investing in real assets gives you a significantly better return over a young person's working life, and put more into the stock market. Lifetime ISAs are frankly a bit of a mess, and they are under a review, and we'll hear the announcements on that, which is a means by which you're helping, through the tax schemes, get £1,000 at the moment, people to save to help purchase a first house. And it's worth saying a few things that haven't changed. Interesting, again, not really seen too much in the press. Big headline, capital gains tax is lower than income tax. Which tax is it more favourable to load your wealth or growth in? CGT is lower than income tax. And that's under 2 budgets with Labour. Widely speculated in our industry they would put CGT up to the same levels as income tax, which is what Blair and Brown did when Labour were last in power. So slightly strange. Transfer of deceased spouse ISA to the survivor, massive. I don't joke about this, but the number of millionaire widow ISA holders I have, as sadly they lose their husbands, is growing incredibly. All the IHT exemptions remain as they were, as does the 7-year gifting rule. I put independent taxation, that's 1996, which is all about the freedom of spouses to move wealth from one to the other to suit their circumstances. And that's obviously a massive area to save tax. ISAs remain as they are, pension tax-free cash remains as it is, as does, interestingly, high-rate tax relief. They clearly can't get the civil servants, the judges, the MPs, all who enjoy high-rate tax relief on pensions, to give that up, despite everyone having to give up a little bit. So there's some sort of cynical views there. I touch on the Winterfield payment because people are beginning to see how this works. If basically you earn over 35,000 as an individual, you keep under it, you keep it. If you earn over 35,000, you've got to give it back. And underneath, I'll just put this. What's actually happening is, unless you've already said I don't want it, you'll have got it probably. You'll have had your letter. £200 if you're under 80, £300 if you're over 80. And what, of course, they've given you, if you earn over £35,000 of income, they'll take back through your pay-as-you-earn coding notice. And what's interesting, this is causing angst because I am seeing regularly people whose pensions, their occupational pension, teacher, nurse, doctor or whatever, is lower than it was a year ago. Why is it lower? Because your pay-as-you-earn coding notice is now beginning to catch up with you, not only on your savings interest in excess of £1,000, but this will also hinder as well. So if you're over 80, you've got to give that £300 back. That's about £80, no rate, it's £25 a month will come out of your net income, i.e. will come out of your coding notice, £17 a month roughly next year. So I've written down here, what you can do is you can opt out. It's too late this year. It seems an arcane process. I will get it further looked at, but literally, would you believe in the guidance, you write a letter. And then at least you'll stop having this fiasco. Because at the end of the day, what will happen is if you get used to a lower pension, you'll spend less money. You'll have a less good time. You'll live down to your income. And my point is, for goodness sake, it's capital, or in this case, a winter fuel payment, that's causing the extra tax through your income. But in many cases, certainly on savings, it's your capital that's generated interest that's then been taken off literally your pension. This is something that I think I'm quite passionate about. So that's your allowances, as you know, 1,000 if you are basic rate, 500 if you are higher rate taxpayer, nothing if you get over 125,000. There is a starting rate of tax, which I won't talk about. And this is what I'm talking about with your coding notices. And good folk just get used to slightly lower levels of income. But it's ridiculous when I see what levels of cash they have. And so what can you do about it? Either you just realize you're going to get less income because you're going to get taken off in your coding notice and just live with it and chill out. Or you may want to either do your own self-assessment form so you know it's all right, particularly with savings interest, or you employ someone to do it for you. And that's an area I'm going to look at just to see how little a cost I can get offered for the basic return so people know that it's all right. And then they are given a bill to pay before the 31st of January. They go to a bank or building society and take some money out. And then guess what? Their income is higher. It's all about how you work it here. You're still going to pay the tax. But I am seeing an increasing number of people saying, well, look, it's a bit strange. My pension keeps going up. The state pension keeps going up. But I've got less money coming in every month. And that's the reason why. Just a little on inheritance tax before I hand over to Corinne. Nothing's changed here. 40%, as we know, 325 a nil rate band. If you've got assets of under 2 million, you've got an extra 175,000 as long as it's going to children or stepchildren. Over 2 million, you begin to lose it until when the estate is 2.7, you've lost the residence nil rate band. The level of tax is going up, not the rates, but the amount of estates that are moving into the threshold. This threshold has stayed the same since 2009. So again, don't blame the current party. It's Lib Dems, it's Conservatives, it's Labour. It's not moved now, something like 16 years, and it won't move till 2031, so that's not being corrected. The nil rate band is frozen till 2031, and there is a lot more tax being paid. And I'm not even sure that that's including an estimate of the changes to the laws on pensions on death, which will raise the level of liability even further. All sorts of options, which I'm not going to go through. This is a Downing who we use for one of our estate planning things, so I'm not so sure about the sort of effectiveness bits, but clearly gifting is the simplest. But everyone has reservations about how much you give an 18-year-old or a 25-year-old, but clearly gift lives 7 years. We've had an absolute sort of pre-budget craze with the use of trusts where people want to reduce their estates but don't want it to go to grandchildren particularly, and sometimes to children. They want to use a trust, so they remain very sensible. Life assurance policies for those fit and healthy enough are increasingly popular as an option. And then discounted gift trusts, which we do a lot of, and loan trusts, and then these type of things, which are business property relief schemes, which allow you, if you hold the shares of qualifying assets for a period of 2 years, only 2 years, then they are 100% exempt from inheritance tax. And we now have had it confirmed in the second budget, obviously, that everyone can have £1 million in each. And again, we've seen a substantial increase in people making inquiries. We tend to only look at these later in life when people don't think they're going to live 7 years, because the returns on them will be lower, around 2 or 3% per year only. You're only really looking at them to save the 40% IHT. So I don't put 60 or 70-year-old wealthy people into these. We've got other things we can look at in the meanwhile. And one final aspect, which we're increasingly deal with as our clients get somewhat older, the IHT 403 forms. The key is, often I'm asked, how do they know? You know, I'm not telling them, you know, my children doesn't know. It's a wrong way round to look at it. The question you should say to yourselves is, how am I going to make this easy for my children who are my executors? That's the question you need to ask, because this form is 8 pages long. If you are using gifts out of income, just look at the detail that is asked for. Gifts out of income, again, increasingly being used by us, where we're raiding pensions that weren't required. We're getting the money coming out regularly from pensions, and then that pension income is immediately being gifted away. Ticks that it's immediately gone from your estate, but there's a lot of recording needed. When's that needed? When you're not here. How can you make it easy? By making sure there are detailed and clear records for your executors to fulfill. And the number of investigations at probate is going through the roof, as is the amount of litigation at probate between warring families. So make sure that the will isn't the one you did at the back of the Smiths 40 years ago. Make sure it is up to date, done properly, properly advised on, and watertight. And I'll just grab this. This is a red book. It's white because I'm stingy enough to not pay to make it red. And on the very back pages, I think it's page 145 and page 146, we've got 2 pie charts, which I think in a way sum up where we now are. So looking at firstly spending, this is their income coming in, the receipts, £1.3 billion of receipts coming in. If you look at income tax, that's the right box. That's 359 billion. You add that to national insurance and VAT, 3 commitments from the Labour Party to not raise those. That's 60% of the income that the government, the country is getting. That's been the problem, and why we've had this debate about manifesto promises. So 60% comes from those 3 boxes that they're not going to do. Look at the figure, 1.3 billion. This is the expenditure box. So look at your own household. I've showed you what the income is of our country. The expenditure of the country, the first thing is, Mr. McCorber wouldn't like this, it's 1.416 billion. So clearly we're spending more as a country than we're earning. And this graphically shows it. You probably can't see it. The top left, about 11 o'clock, the debt interest calculated for next year, £135 billion, which is effectively rounded every £10 that the government spends, £1 is being spent on interest. You know, imagine you in retirement looking at all your income and knowing that 10% of your income is just going in a debt. It's pretty horrendous. And so that figure of 135 billion, dwarfs defence as an ex-military man with the issues we have in the world, which is only 90 billion. It's higher than public order and the police and everything at 62 billion. It's higher than transport. And it's getting damn close to education, which is where it gets interesting, that we're paying more on the interest burden of our country than we are on educating, you know, our children, your grandchildren, whatever it be. We're not the only country, and you know, I don't want to make this overly negative. And America, our debt looks nothing compared to it. But it's an interesting couple of pie charts. Happy to copy those and send them to you. So what are the sort of two takeaways I have? Tax raises are clearly, in the last two budgets, favoured over spending cuts. Stating the obvious. They tried to do something with welfare. The left of the party said no way. So it is a case that spending is going up, and to deal with that, therefore tax is going up. But we do have this headroom. So I think the farce we've seen will diminish, hopefully. And then lastly, and worryingly, I think, tax rises are promised for the future. You saw all that staggering in, the flat line of allowances, the increased tax on savings, property and things coming down the road, salary sacrifice, and spending is rising sooner. So guess what? The timing of the increase of the taxation could be around the next general election, which is something that all parties do. So again, for the point of neatness, tax as a percentage of GDP will reach the highest on record at 38.3% by the 2030-31. Great. It's all over and done with. There's a sense of relief. We can all plan, look at our website, make sure you're on the list to look, get email feeds, literally. You can just click and then we'll feed news stories and things all the time. So if you're not getting those, do say so. And now it's a great, great pleasure to hand over to Corinne to look at the general investment world. Thanks, Corinne.
Good morning, everyone. I am Corinne Lord. I'm an investment specialist in the investment team at St James's Place. So I spend my time looking at what's happening in the markets, why, what we want to do on the back of it, what we're doing going forward, and a little bit about some of our investment products. So I'm going to spend a few minutes just talking to you about what's happened this year. It's been a pretty eventful year, and give some reassurance, because actually things are looking pretty good. So I'll talk you through that as well. So we know it's been a pretty uncertain year. Lots of unexpected things have happened. And so what I'm really showing you here is, in a typical year, what happens is the orange line. So the majority of outcomes are really centred right in that middle, that white line there. But what we've seen this year is much more uncertainty, much more extremes on both ends of the spectrum. And you see that in the blue line there. So lots of extremes on the left side. So do you remember when Trump announced those tariffs and the back and forth with China and the impact that that was having? That really shocked markets on the downside. So that's lots of extremes on the left-hand side. But we also saw lots of extremes on the right-hand side too. Lots of positives and shocks to the financial markets. So the resolution really of the tariffs, they haven't really impacted markets in the way that we thought they had. The huge impact that AI has had, that technology's had, much more people investing as well. Retail investing we've seen really proliferating this year. So there's been extremes on both ends of the spectrum, lots of opportunities, and I'll talk you through a little bit about some of the opportunities that we're seeing and that we've found in light of the uncertainty. So what has happened year to date? I mentioned Trump, I mentioned the tariffs. We saw the big shock from his announcements in April. So I've got the red line there, which is showing Liberation Day, he announced it as. So that's when he was talking about the tariffs that he was going to put on China. And there was a huge market response on the back of that. You might have seen the headlines in the newspapers. Markets were really, really shocked, and you saw the massive drop. We actually saw the 5th biggest drop in markets since World War II on the back of his announcements. But probably more remarkable, a bit more spectacular following that, was actually how markets have recovered. We've seen a genuine, remarkable recovery since in the 6 months following. I've split it out into regions here so you can see just how the recovery has been split regionally. And probably most interesting is so blue is UK, orange is US, and purple is more emerging markets. And you can actually see it's US which hasn't quite had the same recovery as other regions. So that has actually lagged more than other regions quite extraordinarily, especially if you're looking at news headlines and the data that's been coming out. But interestingly, US hasn't quite had the same recovery post Liberation Day. And on the right-hand side there, that's the volatility. That's the shocks that we saw to the system and markets following the announcement. But again, really, hopefully reassuringly, that has really come down as well. So we've actually settled down to pre-announcement levels in terms of volatility in markets. So overall, yes, there's been some huge shocks, but markets have been really resilient and recovered pretty well. So on the back of that, I thought I'd talk you through what we're doing, what we're thinking in the investment team. I'm not going to spend too long on this because I'm sure you're aware of the things we do. But ultimately, these are our 4 areas of focus and what we're doing. So number 1 is clients and you and what you want and what you're thinking. That's the first place that we think in the investment team. That's where we start. Having active views is really important to us. So not just following what the market's doing. You saw the big shocks we saw in the market and how detrimental that would have been if we were just completely tracking the market. We think it's important to make active decisions in the team. Being diversified, so making sure you have exposure to a broad spectrum of areas, regions, styles, asset classes. The market is really focused on the US in some senses, and you can see it hasn't quite recovered in the same way that other areas have. So making sure we're exposed to other regions, UK, emerging markets, Europe, Japan, places like that are quite exciting opportunities. And discipline, making sure we're not being swung by announcements and headlines, which might be more sensationalist than they necessarily have to be. And it's not just about what's cheap and what's expensive. So I'll talk a little bit about valuations and what that actually means, but it's not just about what's cheap and what's expensive. It's in the context of all of these things. So you'll probably be familiar with that technology, those big companies that you'll have heard of and be familiar with that are really dominating markets at the moment. So Google, for example, Amazon, those are really expensive, but what does that actually mean? So valuations for us is what provides good value for money. So fundamentals, so are their balance sheets strong as companies? Are they doing well as companies? That really factors into what's expensive or what's cheap. The broader economic environment. So in the team, we think about where interest rates are going. We think about inflation. We think about the broader context of policy and things like that. That also factors into what's expensive and what's cheap. So the current economic environment can really factor into the direction that particular areas are going to go into. Behavioural flags. So as we know, technology is really, really popular at the moment. But is that a good place to be? It's very expensive, but is that expensive because it's got really strong balance sheets? Or is it expensive because of the rise of AI and how popular that's been for retail investors? That's something we think about as well. And tail risks. So these are the known unknowns. So for example, the US election, before Trump got elected, we didn't know where that was going, but we knew there was going to be lots of uncertainty following. So really positioning for preparing for what's going to happen rather than predicting what's going to happen. And all of these things factor into where we want to be and where's good value for money and good value for you. And that kind of leaves us with this. And so on the left-hand side, I'm showing you what we think there's good value opportunities regionally. So where we think there are really exciting opportunities and where we think there are less exciting opportunities. So as you can see here, I've talked about the US. The US is where we think it's expensive and there are slightly less exciting opportunities. It's a really concentrated market. And so by that I mean, and I'll show you in a couple of slides, the market is really made up of 10 big names, 10 key stocks. And that's a pretty risky place to be if you're only invested in 10 names that are really, really volatile to what broader markets are doing and what the US is doing and what the dollar's doing. So we think we are finding opportunities outside of the US a lot more compelling, really good value. And for us, that's the places where we're slightly positive. So areas like UK, we think that's really good value for money. And interestingly, I do want to stress, there's a big difference between UK companies and the UK economy. They're actually at odds at the moment in terms of how well they're doing. The UK economy is a little bit stagnant at the moment, not quite doing as well as it could be. Whereas UK companies are actually thriving, really doing really well, strong balance sheets, really strong earnings, really exciting growth potential, but pretty unloved by the market, so really good value for money. So UK companies are doing really well, we like them. Europe as well, similar. Japan, we're positive on Japan. We think smaller companies within Japan provide a bit more exciting opportunities. Emerging markets and smaller companies as well. So they're the areas where the market isn't quite pushing up the price as much, but there are really good, exciting growth opportunities and growth potential. So that's where our views are, and I'll delve into a little bit why in the next slide. But on the right-hand side, I've got a bit about the macroeconomy. So I work quite closely with our chief economist, and we think about where interest rates are going, the broader environment globally and in the UK as well. So another bit of reassurance as well is we think there's going to be a soft landing, and in simple terms, that's really what we think of as a Goldilocks environment. So inflation comes down slightly, but we still get solid growth, but without pushing inflation up. Interest rates stabilise, so we have the okay but positive scenario, which is a little bit reassuring. You might be familiar, we had the US shutdown a couple of weeks ago. Thankfully that ended, the longest ever US shutdown, 43 days I think we got to in the end. But because there was no data out of the US at that time, we weren't able to reduce our recession probability. So that's would likely come down when I speak again to our economist on reviewing those. So we're actually in an okay position, in a pretty positive position actually. We don't think there's going to be a global recession, and growth and markets have actually been pretty resilient, which is a really good place to be. It's actually the second best time in history to invest. I spoke about the US and how expensive that is. And here I'm showing exactly what that means. So this chart is showing you that US equities are really continuing to trade at historically high valuations. And that 63% means that on average, investors are paying 63% more for each dollar of US earnings than they have in history. So it's extraordinarily expensive in the US. Not only is it expensive, it's also very, very concentrated. So I've got here the MSCI index. So the MSCI is the stock market, and it's made up of about 2,500 companies. So if you invest in the MSCI, you think you're exposed to a huge number of companies, a huge number of regions, sectors, styles, all of that sort of thing. But actually 70% is in the US. And of that 70%, 36% is only in 10 companies. You might be familiar with the companies, so Google, Amazon, Tesla. Anyone know of any others? Facebook's in there. Yeah, exactly, yeah. All of those big names that you're familiar with make up almost 40% of an index that you think you've got exposure to a huge range of things. So I think it's really important to have an investment team really behind you to support you, to not be in a really concentrated area. And these are the areas that were really hit when Trump announced his tariffs, for example. They're really, really exposed to the dollar as well, which we know has been weakening under Trump as well. So it's really important to be exposed to a broad range of areas, sectors, not just these techie, expensive areas. A question that I get a lot when I go to meetings is, why would you invest outside of the US? And I really encourage people to kind of broaden the time horizons they think of. It's really easy to be stuck in the last 10 years. And you can see that on your right-hand side there. So that's, why would you invest anywhere but the US? From 2010, the US has done exceptionally well. So you can see, what color line is the US there? I think it's purpley, the purpley bluey line. The US has done fantastically well since 2010. But if you cast your mind looking back to the 2000, it was actually the weakest area that people have been really stuck in the last 10 years, what has performed well. But the research we've done in the team, so we've looked at research from, I think it's from the last 100 years, and these things tend to be pretty cyclical. And we've seen every 10 years the dominance kind of changes. And we saw it was actually emerging markets that the following decade that was the best performer. So it's not a case of the US is going to continue to do fantastically well. We don't know, but what we're doing, even if they do fantastically well, we're finding just as good opportunities in less risky areas. And I've spoken about why diversification is important. And what I mean by that is this patchwork quilt, which is showing you the top performer in a particular year, so the top performing area. So, for example, 2015, emerging markets was the top performer. And the bottom performer there in yellow, you can see is UK property. And what I think is a really key takeaway from this is it's really, really difficult to predict what a top performer is going to be the following year. So that's why it's so important to be exposed to all of these areas, but have someone or a team behind you selecting these in the right way and choosing the right managers in each of these areas. Because as you can see, there's so little correlation each year of the top and bottom performers. And you want to be exposed to all of these things, but the best managers in each of these areas. Market falls can really distract from overall gains, and I know this from first-hand experience, and I have friends and family who, during, for example, the drop that we saw in April following the tariff announcements, were really scared about investing, wanted to take all of their money out. And this chart really kind of shows that nicely. So the orange dots are the biggest falls that we saw that year. And you can just look at, for example, year to date. So the slide right on the right, the bit on the right-hand side, the biggest drop that we saw year to date was about 13%, so a massive drop. But the blue bar is actually showing you what the year ended up as. And you can see the vast majority of the time, the year ends up positive. So it's so easy to be a bit spooked by markets when there's a drop. And of course, I know it can be really scary, but the vast majority of the time, markets recover, markets are really resilient, and you can see that here. They've ended up positive vast majority of the time. And again, why staying the course is so important. So I've got here, if you invested £100,000 in 1988, and just let the market do its thing, just stayed invested, let the team work on your behalf, you would have made 2.8 million. If you took out your money and just missed 10 of the best days since 1988, you would have halved your return. So not only is that quite shocking in itself, but what I think actually is the key thing for me and the key shock for me here is actually those 10 best days happened during times of crisis. All of those 10 best days happened during times of crisis when people wanted to take their money out or were really scared about what was happening in the market. But again, a key thing is markets really often, they recover and they do their thing. And you can see that here. Just 10 days would have halved your return. And these are during times of shocks. So I'm going to leave you with what I think is a really key checklist for thinking about if you want to make changes, if you do make changes, and what we think about in the investment team before we do anything sudden. So, for example, a shock that happens, or there's an election, or Trump announces something else, or the UK government has a budget, for example. Do you have confidence in predicting the outcome? If you can you predict the market implications of that? Are the impacts likely to be material in the long term? And does it change any of your objectives? And if you really can answer yes to all of these things, the final question is, are your investments appropriately diversified? Are you in a broad range of areas that aren't subject to the massive shocks to the system? And if they are, I really think you can take a step back and relax, because the markets recover, they do their thing, and what we're doing on your behalf is really ensuring that your investments, your portfolios are resilient to a huge range of outcomes. We don't necessarily know what's going to happen, but it's important for us to be prepared for what's going to happen, and that's what we've been doing and what we've done over the past year, expecting more uncertainty, but also it gives us the opportunity to find lots of exciting areas for investment. I'm going to pause there. Any questions we're going to come to at the end, please do give me any questions. Happy to answer anything on what's happened in the markets or what we're doing. But I'm going to hand back to Richard, and then we'll come back at the end.
Right, I'm going to just follow that and endorse just a couple of points and then a number of other things just to wind us through. And what I've tried to do is pick out some practical points which are quite interesting in the general investment scene. Let's start in America, which we've talked about quite a bit. What's quite fascinating is the level of revenue tariffs are producing for the American government. And we're forecasting something like 500 billion by the end of the current year in dollar terms. So this is very significant, and it leads to a number of interesting plays as we go along. So it's not talked about a great deal. The Americans are obviously aware of it, and it's what will happen next. But in the economy, obviously tariffs can be viewed as an additional tax for the consumer, and often it will be the worst off that are finding it toughest. And this is going to be very interesting as we go through to the midterms, because popularity for Trump is beginning to fall. And you can see on the right the goods imported from China, domestic goods, and even Canadian goods, and everything is costing more. So there's inflationary concerns. That's why the Fed has held off until recently with base rate cuts, much to Trump's annoyance. We do see them cutting again next month. But they obviously have concerns that increased costs, both domestically and imported, are going to cause a problem. And with China producing 80% of rare minerals around the world, which are the things that keep most of the gadgets that everyone's on working, there are obviously very significant concerns. But one of the answers given by Trump, and it's a quote, it's possible we'll do a complete tax cut because I think the tariffs will be enough to cut all of the income tax. Well, that's a pretty normal Donald Trump line, isn't it? He won't have said that in the future, I'm sure. But what this slide's trying to show you is one of the first two columns are just the amount of money that the tariffs have raised and how much it could raise. And if you look at the far right-hand column, 672 billion pounds, $1 billion, it may be quite close to that in what Trump's raising in tariffs. And that is the amount of tax paid by the poorest 80% in America, with the other 80% obviously paying a huge amount of tax. So as we come to midterm elections, which are vital for him to continue in a strong position and continue to make all the things he wants to do, keep an eye on, one, the impact tariffs is having on the economy and the individual, and two, what they may or may not do with the actual revenue they're getting. And then more domestically, you know, there is something very strange going on. The number of people that can work in Britain has been exploding that don't work because they're sick. They're not unemployed, they're sick. And on the BBC website, just yesterday, just to give you context, of 16 to 24-year-olds, about 2 million are students, but just under 300,000 are sick, between 16 and 24, registered for sick. Between 25 and 49, unemployed is about 500,000. People who are sick is over £1 million. And then when we get to 50, 64, you would think that, yeah, it's acceptable to a degree. There's a high amount of sick, but the sickness number of people are 1.4 million. So there's an endemic in the UK, and it is a UK thing, about the number of people that are not working but potentially could. And that's before we get to the Employment Rights Bill, which is going to put employers off potentially employing people. And again, you've seen overnight the headline that they've ditched. Basically, a one-day-old worker had rights not to be sacked. And the House of Lords has said, and they've had to do a U-turn on that. And clearly the Employment Rights Bill is going to make it slightly more difficult for employers to commit, we think, to jobs, and so the CBI say. Unemployment rates above 5%, real wage growth isn't really going too well. So a lot of issues, as we said, politically and in the country, but again, very different, as Corinne said, to the actual outcome of investing in UK companies, many of which are very global. But let's go across the channel. And what's happened in Germany is quite amazing. Germany, the country that held the EU back from borrowing, that always had a very positive outcome with taxes always being higher than spending. It's changed dramatically. And this shows you the implementation led by Trump basically saying, I'm not going to support NATO, you've got to stand on your own 2 feet. So what Germany is committed now to spend on defence and infrastructure compared to both the Marshall Plan and the reunification is astonishing. And it's it's quite interesting. If I said to you, I've given it away, what was the best performing fund through the diversification that Koreans had? It's actually continental Europe in the current calendar year to date. May not be, but the market is beginning to wake up to what Germany has done. And again, the trends that you can see both in unemployment falling and loan growth going up are quite interesting across the continent. And here's the quiz for you. This is what the Nasdaq has done for the last 3 years. That's the black one. What's beaten it? And it's not Europe, it's European banks in particular. So what we're trying to say to you, we talk about the Magnificent Seven or the Magnificent Ten. America dominates the investment world, but actually, as a statement of fact, in the last 3 years, particularly European banks have outperformed the technology sector. Not many people realize that. And then if we go further east, we see a changing story from an investment point of view in China. So China, in the 15 years from the turn of 2010, had grown by something like 6 times, 600%. Sorry, the US had grown by 600 times, 600%. China by only about 125, sorry, by about 25%. Not a great deal. But look what's beginning to happen over in China and the market recognition of the need for diversification. So 6-to-1 American growth compared to China. What's interesting, a good article in the Telegraph yesterday from Tom Stevenson, who works at Fidelity, is the number of patents registered in China compared to America over the same 15-year periods is 6-to-1 in favor of China. And there is a clear view that the technology, the unsung technology heroes moving forward more and more, maybe east and not on the Pacific Rim in California. So again, I'm repeating but doing it a different way. Korean's absolutely right. We don't know what's going to happen. I'm not saying put all your money into China and Europe and get rid of America, but there are things that are changing, and most private investors that do it themselves, what do? They look at what's done well and they add to it, often at exactly the wrong time. They don't sell what's done well and buy what's done badly. What Corinne's talked about is the principles and the discipline that our investment team have to ensure that we are doing the complete opposite. And I like the quote at the very bottom, diversification is the only free lunch in investing. I think that's a really good quote to have. And then behind, Corinne, what our investment team makes sure is not only do we give you diversification by geography, but by investment styles. And we think that is so important. So the 3 core styles of value, quality, and growth are covered across the board. And this is a little bit hard to see, but what you can see is in our global equities, you've got different managers that are appointed that have different specializations, apparently doing the same thing, investing for growth in global equities, but doing it very, very differently. And I guess in the UK, we know on the right, Bailey Gifford, Scottish Mortgage, very much known as a growth-based fund or fund manager, whereas you've got people like Dalton, Lazard, Redwheel, to a degree Artemis on the other side, very much more value-based. And of course, most of your managers are not actually based in Britain, and still a nice minority don't manage any other retail money in the UK. And this is one of the continuing themes that we have of being able to get literally incredible talent that I have never heard of. where you get some of these managers from, and then you hear the backstory. It is fantastic. So they have genuinely a very worldwide view, and as I said, in some cases exclusively managing only funds on your behalf. Now, I just want to touch on this diversification theme with the briefest history lesson, which you all know. This shows the 2 years from 1998 to 2000. And it shows the wonderful Henderson Global Technology Fund. Do you remember it? We had lots of different technology funds there. And I wanted to remember the date, because everyone says there's going to be a crash. So I just wanted to remember the date that Alan Greenspan gave his famous speech as a central banker and said there's irrational exuberance going on. That speech was in December 1996. So I just want to make you aware, every expert's got to say there's going to be a crash, because they'll get it right as long as they repeat it often enough. And so a year on from that, this graph starts at the beginning of 1998, and that technology fund grew by 317%. And I vividly remember, the next one was Standard & Poor at 58, and we had Andrew Green running the next fund, which was then called the Recovery Fund, 41%. Nick Purvis running a fund out of Schroeder, 21%. Neil Woodford, would you believe, running a fund out of Perpetual, 19%. Look at that. Look at the pressure those people were under when everyone was getting this dot-com boom. The internet is the next thing. It's going to be huge. And remember what many private investors did. They got out of these underperforming UK or value-based stocks, and they got into something like technology. 2 years on, this is what happened. So for 2 years, from 2000 to 2002, that technology fund's down 55%, the S&P is down 12%, and all of those funds have made money, And we remember the dot-com boom and bust, so we're talking 2 years out of the 3 bust. 3 of those funds have made money. And Korean, again, this is the only overlap, 10 years, absolutely right. I had great difficulty very recently convincing a 35-year-old that the American market had underperformed for a 10-year period from 2000 to 2010. Didn't believe me, because you are indoctrinated by what you see and what you feel and what you've experienced. And that is absolutely that America has boomed and that other areas are not the places to be. So the message is, don't just look at history. Often it can put you in a position where you're making bad judgments. And the second message is fantastic teams that we have based in London, but using world quality managers to help make those decisions for you. And then John and I, hopefully, when our face-to-face meetings, sense checking you. So just a simple example, our North American fund hasn't done very well this year. It's got one, I think Microsoft, of the Magnificent Seven in its top 10 holdings. Now, is that right or wrong? Only time will tell, but I love being able to tell someone why something has underperformed, and very, very rarely do they ever worry about moving out of it, because it's the broad diversification we need. Let's just quickly whip through a couple of other things. This is significant if you've got a lot of cash. You can go up to 120,000 from Monday. The Financial Services Compensation Scheme is changing. We take note of this. I vividly remember 2008, 2009, my panic calls when banks were going bust. Well, it wasn't about the stock market, which was 20% down. It was about, is my cash safe? I don't personally understand anyone that would want to keep more than the compensation level in a bank, particularly with national savings, which I'll come on to in a second. Interest rates, these are the best, current best, and there are ones with bonuses and banks that I don't really know and aren't such good credit rating. But Close and Family, I love Family because it's a Family Building Society. That particular account is a market tracker, so you know it remains competitive. Instant access, you can get it however much you want. And cash ISAs, I love Ford Money, would you believe it is a motor company car. Again, they have a guarantee to keep it competitive. Premium bonds, I'll come back to NS&I at the moment, giving you 3.6% tax-free. We have a very large amount of clients' wealth in premium bonds. We include that monitoring. NS&I are very good with intermediaries, so I hand clients a sheet, and if you're not doing that yet, let me do it, which tells you your winnings in the last 12 months. And by and large, the evidence I have is that everyone's pretty much hitting this. One lucky person, I don't think they're here today, had a £50,000 win in February, living up just north of Ripon. Now, put those in your mind. Instant access, early fours, fixing. I think this is a no-brainer right now. I think that base rates will fall on the 18th of December, and that view has strengthened from consensus view post-budget, currently at 4, likely to go down to 3.75. So you are already, if I just go back, you're at 4.2 for 1 year, 4.4 for 2 years. You're getting more than you can instant, and the market's predicting an interest rate fall. And the other interesting thing is NS&I, out of a budget, National Savings and Investments, the government's bank, have been given a larger funding target for the next for the next financial year. So they've got more money to grab, and therefore the way they do that, hopefully, will be to give you better rates of interest. So interesting, very rarely do I see NS&I as a fixed rate being amongst the better areas. So clearly fixed. If it's non-ISA, you cannot get at it. So don't overexpose yourself just to get that extra 0.5 or 1% or whatever it be. You've got to firstly have enough liquid that you can meet all emergencies, you can sleep at night, blah, blah, blah. But if you want to have a wider base of cash, then it's allowed, clear, fixed, because you can actually get better rates by just doing it. You can get reasonable rates 3, 4, 5 years out. I'm very hesitant about going too far out. It's hard to tell what's going on. And the reward for losing access to money, I don't think is enough. And on that theme, out of the budget, quite unusually, some moves by the Chancellor, which are definitely aimed at dampening inflation. So £150 off household energy bills from April, no increase to fuel duty, prescription charges frozen, and rail fees. Now, those all will lead to the inflation bucket having less pressure. There's obviously lots of external factors, but that could well lead, and the city think it will lead, to lower inflation. There's lots of other factors like tariffs and wars and unknown things, but we do see base rates going down to 3.75 in December. The jury then is out about 2026 in terms of how much further rates will fall. It's not out about they will fall. And one side is they may only fall down to something like 3.5. Roger Boodle, Capital Economics, who we rate highly and get things right more than wrong, actually predicting down to 3%. So that gives you a feel of interest rates. Couple of domestic things now. We wrote to you all in April, and we have, after 33 years, changed the way that we charge, and across pretty much all equity funds, we've reduced your charges. Some of the bond funds and the money market fund have gone up a bit, but most of you are 80, 90% in equities, and you've seen charges go down. What we've also done is joined the rest of the industry. As you know, at the end of each year, you get a report, and you get on page 6 in a big capitals, your charges, your costs and charges, and it was one figure. It was what we call a bundled charge. It added everything up, which was effectively the manager fee, the advisor fee, and the platform fee. We're now separating it out. We can report it to you every day if you wish. You will continue to get it clearly with your year-end report. And it's broken down so that the advice charge in total is 0.8. John and I don't get all of that, unfortunately, but we have got a small pay rise. The product charge, which is effectively the platform charge, is either 0.27 for your ISAs and unit trusts or 0.35 for your bonds. And then the fund charge is varying from 0.09 to about 0.69. But we estimate it's around about, things have gone down to within ISAs about 1.59, maybe 1.6 within a pension. And then there is an incentive to have larger sums of money with us, because the larger that you have, the lower the platform fee will be. And as I said, one, talk to us any time about it. I'm covering it in reviews, as I know John is, and it's made things very clear and very simple. And what it's done for Corinne and my investment team is actually, I think I've got to get this right, the statistic is now that 95% of St James's Place funds with their now explicit fee are below their average in their investment association sector. So that is a statement of fact. So from what we've had to do is these things like top of the dog thing, Spot the Dog, which has been discontinued, was unrepresentative of facts because it showed St James's Place with all their fees added together, and it compared it to funds with no platform fee and no advisor fee. And however much we said that in a 1 or 2 page reply to journalists, so that St James's Place spokesman said, guess what? That was never put in the response. So what we've been able to do is make it much clearer what you pay for advice, what you pay to have it on the platform, and what the manager is paying. And some of the charges, particularly now even compared on the passive side to Vanguard, are highly, highly competitive. And that leads me from cost and advice to value. So a good article not too long ago in EFT talking about the 3 stages of retirement. And this is a polite bit. The active stage, the beginning of retirement, shall we say. I like how they call this next one the settled stage. And dare I say, the support stage. So it was aimed at just sort of talking about the needs for advice in those different stages. And this is what John and I do in our sort of day job. And what we're seeing, I mean, we've had an incredible year of instructions caused by all the doubts and concerns. But the need for advice, and it's not just a statement we make to our analysts, it is just going through the roof. That is why I have 5 ladies that normally attend. 2 have had to stay in the office today because they've got to make sure all the regulatory issues that we have to deal with in certain times following instructions are complete. And what is the value of advice? It's easy to say the charge is this. It's much harder in general terms to say what is the value of advice. And that's a very individual component for everyone to discuss. And we've had a number of occasions in the last few years where we've raised this. And I've just tried to set out about 10 areas. I think one of the most important things is stopping clients going off on a tangent and putting the tax horse in front of the tax tail in front of the horse. I think I've got that the right way around. And to stop reactions because of politics and actually say, what are you trying to do? And often it's different things with different sums of money. Because I think if you set clear objectives right at the beginning, it is then much easier to ignore volatility, fashion or whatever, and ensure that your broad plan is then met. And then the key part is that we provide advice to fulfill those objectives. We implement them very cost effectively. And then it's important to monitor them. There's no good just leaving it. You've got to rebalance every year to make sure that the portfolio is still intact and doing what it needs to do. And this is, I guess, evidence very recently. If you look at the platforms, and we're starting to see the figures, the amount of money leaving pension tax-free lump sums because papers were talking about it. Journalists were saying they're going to do it. Oh, my goodness. Irresponsibility. And what they've done, they've taken money out they don't need. They've put it in a place where the government's now going to tax you even more. And this was because they didn't have objectives. And the advised platforms, the level of money going out was substantially less. Not because advisors were trying to hang on to their fees, let me be clear. There were 1 or 2 very good reasons for people to take some action. But in most cases, the objectives the client had set were nowhere near linked to a move because of something in the Daily Mail or the Telegraph. And so we move on. It's then checking that you're minimising tax, making sure that you've done your ISAs right at the beginning of a tax year. As I said, rebalancing, making sure the legal advice comes in, making sure you've done your lasting power of attorney, that the people who are your executors are not your brother who's now 80, but your children or your nieces or your nephews. Making sure, as the FCA now guide us, that when you get to an age roughly in your mid-80s, we are guided sensibly to start to involve the next generation. And I've been told a number of times recently, you're being handed on, Richard. And it's great to make sure that the next generation is increasingly getting the right advice and reassures their own parents. So I talked about the 3 ages of advice: active, settled, and support. This was the end of the article, describing those 3 ages in a rather naughty way. So if there's nothing else for you to take away, when you go home and meet your husband, your wife, your friends, and talk about this, you've got to say whether you're a go-go, whether you are a slow go, or just the no-go. So I quite like that, and it's for you to make those comments, Marav and I. And then lastly but not least, St James's Place is in rude health. We've talked at times and these sort of things where the press has been completely on our back. We've got a number of things wrong without any doubt. We haven't been external facing. All of that, I think, is corrected. And in our third quarter figures published to the stock exchange on our website, we've gone through the 200 billion mark. The nearest competitor, which is Quilter, 112 billion. So I'm not saying big is good, I never have, but there is a significant momentum there. These are the various stories after each released from our quarterly figures. So stock jumps at the beginning of the year. The FT, don't quite know where they got this headline. St James's Place shows the value of snob appeal, slightly ridiculous. And then just more recently, after our third quarter figures, celebrates its redemption. And I think we are a huge organisation now. The importance for you of big is what's behind us. And Corinne's given a great example of that. And the resources we have to monitor these managers, to then John and I get all the technical resources, I have to say, are incredible and have moved up way much more than they were 10 or 15 years ago. So all good. I'm going to leave you, before we go to questions, with an answer. And you're going to have a quiz. This is the answer. This is like, have I got news for you now? What was the question? I like that quote. If more government is the answer, then it really was a really stupid question. Dear old Ronnie Reagan apparently came up with that, which you could probably imagine. So we're going to go into questions. We're running really well, probably 5 minutes for questions. Normal house rules, please. Oh, Rebecca's here, so that's great. I got a name wrong last time, so if I call you Fred or Bert and your name isn't Fred or Bert, I do apologise. 1 question per person. Try and make it general, then it's relevant for anyone else. Who's going first? Brilliant.
Thank you, Richard. In the Mail, we've seen a lot of comments about diversification of portfolios. And gold and silver is one of the things they're saying you should be into. Some are recommending 20% of your portfolio. Is any of your investments through commodities and gold and silver, or would it be something you recommend?
I'll do the first bit, come to you. I mean, my first bit in answering is, yes, our managers have the freedom to invest. Oh, sorry. So the question was gold, basically, and commodities. What are we doing in St James's Place? What's the sort of exposure? And the way we do it, no, we don't have a specific physical gold fund, which are out there. You can buy those on the market with ETFs. We certainly have managers that own gold mining or commodity-based companies. And Kareem may or may not want to go on this. And what we won't do is we will not tell them to put more or less in, because our decision-making is top-down, getting the right managers. But I guess on the value side of the equation, we may have more miners. I don't know if there's anything.
Yeah. Can you hear me without the microphone? Yeah, sure.
I think it's on,
Is that okay?
Yep.
Oh, perfect. I think a good thing to think about gold and silver as well is that it's very much a speculation-based asset. It's driven by what markets are thinking and doing. And I spoke about some of the behavioural flags. And what are I think the key question is, what are the reasons you want to invest in that? I think once you can answer that, thinking about how people value gold as well. It's very much driven by market direction and sometimes often panic in markets. And for us in the investment team, we're thinking about, we've really curated a way that we want to invest and what is the benchmark for introducing an asset that is often speculation driven, and what would we have to remove from the research that we do and the history that we know regarding bonds and equities. What would we have to take out to add this other asset, and what would it actually add to portfolio? So that's why we don't necessarily invest in it directly.
Yeah, and I think the only other thing I'd add, I don't know if John's got something, is it's interesting, we only hear about it 3 years after it was probably a good entry point. So it's already made 120% or whatever in those 3 years. So the entry point now is probably a much lower case than it would have been before. So yeah, it is partly covered, but not as a specific identity. I think I saw another, yeah.
Richard, you've shown an enthusiasm for Japanese funds, but there has been a certain amount of speculation in the press recently that the Japan economy could be heading for a trust moment.
Yes, the new first female prime minister. I think, I'm going to pause with Corinne, and I think we tend to have not much more than 5% in Japan, but if you look at the basis of the industry that's in Japan and not the politics, and you look at diversification away from America, I think there are some incredible businesses in Japan that I'm very happy to have our clients' wealth in. And it's a bit like the trust moment in Britain. Did we abandon British shares in Unilever, Diageo, Tesco, or whatever? So I think my answer would be there's a disparity between the politics and the actual underlying companies. And we feel that the beneficiaries of quite a lot of global money, because money, I think, is moving a bit out of America, and one of those areas of benefit for the understanding of industry and brilliant companies is in Japan. But
Yeah, I think I would just second that as well. And it's very much understanding the difference between the Japanese stocks and the Japanese economy. And we do have a view within Japan as well. We like the smaller and medium-sized companies, which are really benefiting from some of the corporate reforms in Japan as well. So small and medium-sized Japan companies are a really exciting place for growth opportunities going forward. So yeah, very much aware of what's happening in the economy and bearing that in mind. That is more likely to be detrimental to larger Japanese companies, and we're steered slightly away from those.
brilliant. Any more questions? Yeah, right at the bottom. There's a microphone, so we can hear you.
Hi, just a general one on the markets, I think, really. Do you think investors' timelines for returns have changed to be much more shorter term, and that's therefore affecting the valuations of stocks and shares that we're seeing at the moment? And is that likely to change in the future?
I've definitely noticed with the proliferation of retail investing and people seeing on their phones and how often are all of you checking what your returns have done. That's really shortened time horizons, especially we're seeing much more younger people investing as well, every single day tracking exactly what's happened. Yes, that has really shortened time horizons. They've been really influenced by short-term history as well, as we saw, rather than looking at longer trends and the cyclical nature of investing as well. So we see these trends that ebb and flow. So yeah, I have seen that change, and it's really put pressure on valuations sometimes for companies that don't necessarily have the fundamental support. So we're seeing really high valuations for some of these AI tech companies that don't necessarily have any history of earnings, any sort of strong balance sheets, but that's pushing forward companies that don't have the robust backing. So for us, that's been a really good opportunity to find great value in really strong companies, but for the average investor that isn't maybe supported by the investment team or SJP, they could see some detrimental returns in the near future.
Yeah, no, I've got a lovely, you would imagine someone who said this to me about having access on a phone, a gentleman of a degree of age who had been an investor for 60 years, and he just nodded at me and said, I like getting things once a quarter, Richard. And I thought, well, he's meaning quarterly valuations. He said, every quarter of a century is just about right for me. and is he wrong? Is he wrong? maybe time for one final question. Are we done? No, I think we're done. We're just about bang on, maybe 5 minutes ahead of time. So that's super. Really enjoyed. It seems it's like the last day of school term. You know, we've got the budget over. We can all just get on with our lives. Christmas is coming, etc., etc. So the key is, I think, you know, try and let us all look for something positive is what I sort of feel in our meetings. You can imagine we're spending the first 10, 15 minutes sort of trying to almost drown out the external noise, often proliferated by a publication, a journal, a newspaper that has a political view. And I just feel that out there it is better. And I think John and I see this regularly. We do with quite a lot of businesses in Yorkshire. And actually the fundamentals are a bit better than the drowning noise that we're hearing from the media. And that's all I would hope, that we will all settle down now and be able to get on, make sure your financial plans are clear, your objectives are set, you minimise legally your tax liability, and you get on with your life doing what you want to do, all in that go-go stage that you should be in. So thank you for coming. Feedback sheets, particularly if you want more stuff on newsletters, because we haven't pressed that enough. You know, you can just tick it, we can mail it to you. It's not intrusive, you can get out of it. Any comments you want, put on the feedback sheets, please. And if you don't worry. And great to see you all. Have a fantastic run into the year, and look forward to serving you very much in 2026. Thank you very much.
Baby boy arrived.
Oh, right. Excellent.
Jack Thomas. 16th of December, exactly on the day planned.
Mum, baby,
Absolutely in hospital. 2 hours later, baby arrived.
right.
No, day after, but nothing untoward, back home. Frozen. So on the 2nd, yeah, so we need to update. So I
Can you put it on the feedback sheet? We're good too.
I can put on the sheet and we can update.
Oh, I'm so pleased. Great.
Yeah, or I'll email.
Everything moves on, eh?
Yeah, absolutely.
The father, son, and grandson. Have you had the picture yet?
Yeah. In fact, the new one arrived today.
Oh, right.
This is the baby that's, that's really six.
Yeah, lovely.
The new one arrived today.
And look, it's on your screensaver.